So what's up traders, welcome back again. I hope you guys are excited for this week, the week beginning the 11th of September. This week is full of economic data, and we are here to discuss one of them. So buckle up, man. As you all know, ECB will be meeting on Thursday, and they have a decision to make. And the decision that they have to make is to either raise rates again by 25 basis points to bring their overall interest rates to the highest level since 2000, or they deliver what we call a hawkish skip, which is leaving rates unchanged, but also leaving the door open for future quantitative tightening. Okay, so we're here to see what are the odds so that we can align ourselves well in this week's trade. So the last time the ECB met was in July, and they raised rates by 25 basis points to bring their main refinancing rate to 4.25%, their deposit facility rate, also known as their DFR, to 3.75%, and their marginal lending facility to 4.5%, all meeting expectation. And this was the highest level the rate has been since October 2008. Okay, and this is what the ECB president had to say about inflation.
Inflation continues to decline, but is still expected to remain too high for too long. We are determined to ensure that inflation returns to our 2% medium-term target in a timely manner.
So in the last press conference, Christine Lagarde kept on repeating one phrase: data dependence.
We will continue to follow a data-dependent approach, so we are deliberately data-dependent and determination based on data. And
the word data dependence means that they are going to make decisions based on incoming data. And what data are we talking about?
What data will be important? All data. And obviously we will be looking at all inflation data. Starting with headline, we will have 2 readings before our next September Monetary Policy Governing Council. We will look at core inflation, but we will go deeper into underlying inflation numbers to really appreciate and understand what is moving and what is steadily, sustainably moving.
So we're going to focus on inflation. We're going to focus on the labor data. We're also going to focus on the PMIs, which measures the levels of economic activities. And also we're going to focus on the inflation expectation. So let's start by talking about the inflation data. So inflation came in at 5.3%, which was the same as in June on a yearly basis. On a monthly basis, it came in at 0.6% in July, which was an uptick from the June's data of negative 0.1%. Core CPI, which strips out the prices of volatile food and energy, came in at 5.3%, which was a downturn compared to the June data, which was at 5.5%. So that's good news for the ECB. So if you compare the level of inflation last year in October, it was at 10.6%. Currently, they are at 5.3, so there's progress, but they're not done yet. So we are going to look at the inflation drivers. What are the things that are accelerating inflation in the Eurozone?
The drivers of inflation are changing. External sources of inflation are easing. By contrast, domestic price pressures, including from rising wages and still robust profit margins, are becoming an increasingly important driver of inflation. While some measures are moving lower, underlying inflation remains high overall, including owing to the persistent impact of past energy price increases on economy-wide prices.
As the ECB president puts it, there are several inflation drivers that may accelerate inflation, and one of them is the energy inflation, which measures the year-over-year change in the cost of energy, and it accounts for 10% of the overall Euro area CPI. And if you look at energy inflation, it came in at negative 3.3% in July, compared to the June's data, which was negative 6.10, which means that energy inflation did tick up. Okay. Also, if you look at the services inflation, which accounts for 43.5% of the overall CPI, came in at 5.5% compared to the previous one of 5.6. There is slow progress in that. So in terms of inflation, well, they have made progress, but they're not done yet. So yeah. And also, if you look at the euro area inflation expectation, the 1 year or the 12-month inflation expectation did hold steady at 3.4%, and the 3-year inflation expectation edged up to 2.4% compared to the previous one of 2.3% in June. So in terms of inflation, inflation is projected to pick up and is projected to remain persistent. Okay. Also, we are going to look at the jobs market, and this is what Christine had to say about it.
The labour market remains robust. The unemployment rate stayed at its historical low of 6.5% in May, and many new jobs are being created, especially in the services sector. At the same time, forward-looking indicators suggest that this trend might slow down in the coming months and may turn negative for manufacturing.
So in July, the unemployment rate stood at 6%, which is at historical lows compared to the June's data of 6.4. The wage growth also did show signs of decelerating at 4.6% in July compared to 5% in June. Labor force participation remained at 74.7% compared in June. Employment change did slow down at 0.2% compared to the previous one of 0.5% in June. So in terms of the labor market is still tight, and that's one thing that has been fueling inflation in the Eurozone, the wage growth, because as wages increases, also inflationary pressures also goes up. So this is an important data that the ECB will be taking into account when making that decision. So there's always an upside risk in inflation. There's always an upside risk in inflation. And when it comes to monetary policies, economists usually like to say that the risk of doing too little always outweighs the risk of doing too much, which means that if they end up over-tightening, the effects of that will be little compared to them not tightening enough, because it risks getting inflation embedded into the economy, and that will take much time to get rid of inflation. It will take rates being set at a very sufficiently restrictive level in order to bring down inflation. Okay, so if you look at the inflation report, both June's and July's, if you look at the labor report, if you look at the inflation expectation report, they are all pointing to one thing: upside inflation risk. So let us look at how the Eurozone has been performing. And based on what I'm seeing, I think trouble is looming in the Eurozone area, because two of its biggest economies, German and French, if you look at the PMIs, if you look at the German manufacturing PMI, it came in at 39.1%. Okay, if you look at the service PMI, it came in at 47.3. French composite PMI came in at 46%. Services PMI came in at 46 also. Also construction PMI came in at 42. Same with Spain, came in at 49.3 services PMI. Also Italy also did register a PMI below 50 for the first time since November 2022. And the overall performance of the Euro area is not showing good signs also. The Euro area August services PMI came in at 47.9, and also the Euro area August composite PMI came in at 46.7. So in terms of economic performance, the Eurozone is facing what we call stagflation. The economy is contracting both on the manufacturing and the service sector, which is not good news, and this is what Christine Lagarde had to say.
The near-term economic outlook for the euro area has deteriorated, owing largely to weaker domestic demand. High inflation and tighter financing conditions are dampening spending. This is weighing especially on manufacturing output, which is also being held down by weak external demand. Housing and business investment are showing signs of weakness as well. Services remain more resilient, especially in contact-intensive subsectors such as tourism. But momentum is slowing in the service sector.
And one thing that you should understand as a trader is that ECB is a single mandate central bank, unlike the Federal Reserve, which means that their only focus is to break the back of inflation. And the ECB president said this several times.
But we are very strongly rooted in our determination to break the back of inflation and to take inflation back to 2% medium term on a sustainable basis. And this decision that was unanimously agreed amongst all members of the Governing Council is driven by one key determination, which is to bring inflation to target, our target, which is medium-term inflation. There is unanimous determination to do so. But I can assure you that on the occasion of today, it was a unanimous determination. And the determination is rooted in one very simple direction: 2%. We want to break the back of inflation. 2% is the goal, and we will get there, come what may.
And what this means is that they don't care how the economy is performing. Okay, they have only one job, which is to break the back of inflation, and they are going to cripple the economy as long as they do that. Okay, and what that means is that the burden of proof lies on the data, which means that the decision to pause or hike it solely depends on how economic data will be coming in. And as you can see, the inflation report, both for July and for June, is not showing signs of inflation decelerating in the Eurozone. If you look at the labor reports, if you look at the unemployment rate, it's still at decade lows. Okay, if you look at the wage growth, it's still very, very high. So, and these are the factors that fuel inflation. Okay, these are the main inflation drivers. Wage growth. If you look at the energy prices, they are projected to go up, especially after Chevron Corp received a notice from its plant, from its Australian plant, that strikes at their liquefied natural gas export plant in Australia will begin from September 7th. And what that means is that the prices of energy will automatically go up. Taking into account that OPEC Plus did announce that they are going to extend their output cut by 3 months till December, which means that the prices of energy are expected to go up. Which are the main inflation drivers? Prices of energy, the labor report, inflation expectation. They're all showing signs of inflation going up. So do your math, man. And yeah. And so let's look at what other governing council members had to say. ECB note said this in a press release that markets may be underestimating the chance of a September rate hike. While a further rate hike is possible, it is not guaranteed, and that the September rate decision is expected to be a close call. ECB Chabel had this to say that stubborn high prices persist, unclear peak rate and duration of restrictive rates, not on a brink of deep recession. ECB Gundois, who is the vice president of the ECB, said this, that ECB is nearing the end of rate hikes, and the upcoming data crucial for September decision. What I've just said, ECB's Kazimir said this, that ECB should raise rates next week, then pause. Inflation remains persistently high, with price growth expectations significantly above 2%, prefers a September rate hike over a later increase, believes it's necessary to take one more step on rates. ECB Centeno said this, that risks outlined in the June growth projection are becoming reality. Eurozone growth indicators have recently shown downside surprises. Okay. Also, ECB Holzman said that a rate hike is possible if no surprises are met, and that the PEP, the Pandemic Emergency Purchase Program reinvestment debate, should commence, and that the ECB lagging can assess policy once at 4%. What are other economists predicting? The money market updated their expectation for the ECB rate hike, and they are currently pricing in around 40% chance of a 25 basis point hike rate on Thursday. Okay, interest rate futures are pricing in a roughly estimate of 65% chance of a pause in September. Okay, so I think this will be a very close call.
We will take the new projection by staff. We're going to take 2 new readings. We're going to take more information about how transmission is taking place. And on the basis of that, we will determine whether we hike or whether we pause. What I can assure you of is that we are not going to cut. That is a definite no. But on the other side, could be a hike, could be a pause. And if it is a pause, it would not necessarily be for an extended period of time, because as I said, it will vary from meeting to meeting, because we continue to decide on a meeting-by-meeting basis, every time informed by the data.
So I think this will be a very close call from the ECB, and that if they hike, that will send markets flying, because right now markets are expecting the ECB to pause. So if they do hike, then the Eurozone is going to be very strong. And as a trader, kindly keep looking at the German 10-year government bond yields, which is the benchmark for the Eurozone area. Okay, before they release their report, be looking at how the German's 10-year government bond yields are behaving, and also the French 10-year government bond yields, which are, these two are the biggest economies in the Eurozone. So kindly be looking at them, see how they are behaving, and then you will know from there. If they hike, definitely, then the euro will gain a lot of strength. So that's all I had for you today. be very cautious. This week is going to be very, very volatile. Okay, and protect your capital as always as a trader. And all the best in this week trading, man. See you next time.